the Chinese electric vehicle giant that outsells Tesla globally, just broke its own all-time sales record. 403,000 cars delivered in a single month, nearly doubling its exports year over year. And yet its stock is down 40% from its peak. Profits collapsed 55% in one quarter. 4 straight quarters of falling earnings. More than 4 in 10 of its own dealers are now losing money. How does a company sell more cars than ever and somehow make less money doing it? That is the BYD Paradox, and today we are breaking it all the way down. Quick background. BYD stands for Build Your Dreams. It is a Chinese company founded in 1995, originally as a battery manufacturer that pivoted to electric vehicles. Warren Buffett invested in BYD back in 2008 and made an absolute fortune on it. Today, BYD is the world's largest electric vehicle manufacturer by sales volume. Bigger than Tesla, bigger than anyone. BYD outsells Tesla nearly 3-to-1 globally. They make everything from budget EVs to luxury sedans to electric buses to trucks. They sell in over 70 countries. They have their own battery technology, the famous Blade battery, which they also sell to other car makers. On paper, this is a juggernaut, a world-dominating company growing at incredible speed. So why is the stock getting absolutely destroyed? In Q1 2026, BYD's net profit collapsed 50% year over year. Revenue fell nearly 12%, the third consecutive quarterly decline. For the full year 2025, profits were already down 19%. We are talking 4 straight quarters of falling earnings despite selling more cars than ever before. How? One brutal answer: the price war. BYD's own founder Wang Chuanfu called China's auto market a brutal knockout stage. That is not analyst speak. That is the CEO of the company describing his own industry as a war of attrition. Price cuts hit a 2-year peak in March 2026 alone. Every time a rival cuts their price, BYD has to match it or lose customers. And every price cut directly eats into the profit on every car they sell. Let me show you the math that explains everything. Every car BYD sells in China today earns them significantly less than it did 2 years ago. Multiply that by hundreds of thousands of cars a month, and you start to understand why profits are collapsing even while sales volumes are breaking records. Volume is vanity. Profit is sanity. And BYD's profit is getting absolutely gutted. And while profits fall, BYD is borrowing more and more. Short-term borrowing spiked 72% in just 3 months to $9.7 billion. Operating cash flow dropped 67% year over year. Inventories ballooned to a record 160 billion yuan. More than 4 in 10 BYD dealers are now reportedly losing money. The machine is still running, but it is running on fumes and borrowed cash. So what is BYD's solution? Get out of China, or at least reduce dependence on the Chinese market by going global at warp speed. Overseas sales nearly doubled in June, up 95% year over year. In Q1, overseas deliveries hit 321,000 units, up 55%. BYD is now targeting 1.5 million export vehicles for the full year 2026. International sales already make up 43% of total deliveries. BYD's Great Tang model, a flagship SUV, racked up 150,000 orders before it even launched and is heading to Europe by end of 2026. The international story is genuinely exciting. But, and this is a big but, the international expansion is not a clean fix. The European Union has slapped tariffs of up to 35.3% on Chinese electric vehicles, specifically to make BYD and others less competitive. South Korea removed EV subsidies for BYD models at the start of July 2026, forcing BYD to offer its own discounts to compete. And here is the brutal arithmetic. BYD sold about 1.81 million vehicles in the first half of 2026. To hit their annual target, they need to sell between 3.69 and 3.8 million total. That means they need a monthly run rate of over 530,000 cars in the second half. They were averaging 301,000 per month in the first half. Same yellow stickman, same design throughout. Okay, here is the section the headline numbers never show you. The stuff buried in the financial reports that most people never read. BYD is switching to the second generation of its famous Blade battery, which is a genuinely impressive tech upgrade. But that switch created internal production bottlenecks during the transition. High-demand models were delayed. Deliveries were missed. Management says the bottlenecks are now resolved. But during Q1 and part of Q2, this hurt production and sales at exactly the wrong time. More than 4 in 10 BYD dealers in China are now reportedly losing money. Think about what that means. BYD can sell cars, but if the dealers who sell them cannot survive, the distribution network starts to crack. If dealers close, BYD loses retail presence. And unlike Tesla, which sells directly, BYD relies heavily on its dealer network in China. 2 years ago, BYD traded at a price-to-earnings ratio of 249. That is growth stock territory, investor excitement territory. Today, it trades at roughly 10 times earnings. That is deep value territory. That is, we have serious doubts about this company's trajectory territory. The market's entire view of BYD has fundamentally changed. Not a small adjustment, a complete re-rating. And perhaps the most stinging data point. Over the past year, despite all of Tesla's very public drama, Tesla's stock went 17%. BYD's stock went down 40%. The company that is outselling Tesla nearly 3-to-1 is being valued dramatically lower. The market is saying something loud here. Whether you agree with it or not, you need to understand what it is saying. Okay, let's be fair and lay out both sides. Because there are smart people on both sides of this trade. The bull case, the stock is 35% below its peak, pricing in a lot of bad news already. Export growth is genuinely explosive. The Hungary factory opening in Q4 2026 will let BYD manufacture inside the EU, bypassing tariffs entirely. The battery transition that caused bottlenecks is now done. And historically, when a market leader in a growing industry trades at 10 times earnings, that tends to be a buying opportunity, not a selling one. The bear case. China's price war is structural, not temporary. The borrowing levels are worrying. Dealer health is deteriorating. Overseas margins are being compressed by tariffs before BYD even gets the scale it needs. And the sales math to hit their annual target requires performance in H2 that would be unprecedented. Plus, if US-China tensions escalate, BYD is right in the crossfire. Same yellow stickman, no design changes throughout. Okay, practically, what should you take away from the BYD story as a young investor? Lesson 1, and this applies beyond BYD. Sales numbers and profit numbers are completely different things. A company can break sales records and still be in financial trouble if the price of every unit is falling faster than volume is growing. Always look at Bowduth. Lesson 2. Price wars are lose-lose situations even for the company winning market share. BYD is winning China's EV price war in terms of volume. But winning a war where you have to keep slashing prices means the prize keeps shrinking. Eventually, someone either goes bankrupt or the price floor holds. But the damage in the meantime is real. Lesson 3. BYD is a Chinese company selling into a world that is increasingly fragmenting along geopolitical lines. EU tariffs, South Korea subsidy cuts, and the US has essentially blocked Chinese EVs entirely. If you invest in BYD, you are betting on a specific geopolitical outcome. Know that going in. Lesson 4. BYD at 10 times earnings looks cheap, but a low PE is only an opportunity if the earnings stabilize or recover. If profits keep falling, even 10 times earnings gets expensive fast. The question is not, is it cheap? The question is cheap relative to what future earnings? All right, let's bring it home. Here is the BYD story in 6 cards. World's largest EV maker. Outsells Tesla 3-to-1. Records every month. Saw 2 but profits down 55% in Q1. 4 straight quarters of decline. C3 China price war is brutal. Every car earns thousands less than 2 years ago. FOC 4 export boom is real. 95% growth, but tariffs and politics threaten it. FOC 5 stock down 40% from peak. POPs collapse from 249 to 10. Market has spoken. C6 bull case exists, but so does the bear case. This one is genuinely uncertain. BYD is the perfect case study for why you can never just look at one number. Sales up, great. Profits down, problem. Stock down 40%, opportunity or warning. International growth, booming, positive tariffs eating those gains, complication. The real world of investing is always this layered. And the companies that look most confusing on the surface are often the most interesting ones to understand. Drop a comment. Are you watching BYD? Is this a buying opportunity or a value trap? I want to hear your take. Like the video if this helped, subscribe for more, and I'll see you in the next one. Peace.